Good day everyone! I am Melissa Maybedro. For today's video, me and my groupmates, Espada Jamaica, Christy Handog, Ednalyn Cabanyog, and Cherilyn Banduquillo will be discussing about the market structures and a price output determination with its subtopics, which are profit maximization and cost minimization in competitive market, cost and revenue functions in a profit maximization and minimization of losses. The objectives of this report is that at the end of the discussion, the learner should be able to recognize profit maximization and cost minimization in a competitive market and recognize cost and revenue function in the profit maximization and minimization of losses. Understand the relationship of profit maximization and cost minimization in a competitive market. Understand the connection of cost and revenue function in a profit maximization and loss minimization. Evaluate learners through a quiz activity. So let's first define what is profit. Profit is the making of gain in a business activity for benefit of the owners of the business. The equation for profit is equal to total revenue minus total cost. Profit is simply total revenue minus total expenses. It tells you how much your business earned after cost. Since the primary goal of any business is to earn money, profit is a clear indication of how your company is functioning and performing in the market. Total revenue. The total revenue is the amount of money that our firm receives from sales of its product or other sources. Total revenue is the amount of money a company brings from the selling its goods and services. In other words, company use this metric to determine how well they generating money from their core revenue driving operation. So, this is total cost. The total cost of all factors of production. Total cost in economics, the sum of all costs incurred by firm in producing a certain level of output. It is typically expressed as the combination of all fixed costs. For example, the cost of building a list of heavy machinery which not change with the quantity of output produced, and all variable costs. Example, the cost of labor and of raw materials, which do change with the level of output. If fixed costs are not altered, example by obtaining a large building or by acquiring more heavy machinery, the rate of increase of variable costs with increasing output will be progressively greater in the long run, owing to diminishing return on additional units of output. In the other words, in the long run, progressively fewer units of output will be yielded by additional inputs of variable cost.
Two important concepts of profit. Accounting profit is equal to total income minus total expenses. Profit is the surplus of revenue over and above all paid out costs, including both manufacturing and overhead expenses. Income profit is equal to accounting profit minus opportunity cost. It is the difference between a company's total revenue and its opportunity cost. Functions of profit. Measures of performance premium to cover costs of staying in business, ensuring supply of future capital. Types of profit. Supernormal profit. Supernormal profit is all types of expenses profit a firm makes above the minimum return necessary to keep a firm in business. Supernormal profit is calculated by total revenue minus total cost, where total cost includes all fixed and variable costs plus minimum income necessary for the owner to be happy in that business. Normal profit. Normal profit is defined as the minimum level of profit necessary to keep a firm in the line of business. This level of normal profit enables the firm to pay a reasonable salary to its workers and managers. Normal profit is a profit metric that takes into consideration both explicit and implicit costs. It may be viewed in a conjunction with economic profit. Normal profit occurs when the difference between a company's total revenue and combined explicit and implicit costs are equal to zero. Negative profit or loss or a net loss occurs when the sum total of expenses exceeds the total income of revenue generated by a business, projects, transactions, or investment. Business would report a net loss on the income statement effectively as a negative net profit.
Reasons for aiming at reasonable profit. Preventing entry of competitors. Profit maximization under imperfect market conditions generally leads to a high pure profit, which is bound to attract competitors, particularly in case of a weak monopoly. The firms therefore adopt a pricing and a profit policy that assures them a reasonable profit and, at the same time, keeps potential competitors away. Projecting a favorable public image. It is often becomes necessary for large corporations to project and maintain a good public image, for if public opinion turns against it and government officials start raising their eyebrows on profit figures, corporations may find it difficult to sail smoothly. So most firms set prices lower than that, conforming to the maximum profit but a high enough to ensure a reasonable profit. Restraining a trade union demand. High profits make trade unions feel that they have a share in the high profit and therefore they raise demands for wage hike. Wage hike may lead to wage price spiral and frustrate the firm's objective of maximizing profit. Therefore, profit restraint is sometimes used as a weapon against trade union activities. Maintaining customer goodwill. Customers' goodwill plays a significant role in maintaining and promoting demand for the product of a firm. Customers' goodwill depends largely on the quality of the product and its fair price. What consumers view as fair price may not commensurate with profit maximization. Firms aiming at better profit prospects in the long run sacrifice short-run profit maximization in favor of a reasonable profit. So here is the profit maximization. A monopolist maximizes profit by choosing a quantity where marginal revenue equals marginal cost, a process that companies undergo to determine the best output and price levels in order to maximize its return. Approaches to profit maximization: total revenue, total cost method, marginal revenue method, marginal cost. Profit maximization fundamentals. Profit is equal to TR minus TC. Total revenue or TR, this is the total income a firm receives. Total cost, it refers to the total expense incurred in reaching a particular level of output. If such total cost is divided by the quantity produced, average or unit cost is obtained. Marginal revenue. It is the change of revenue which comes from selling an additional unit of output. Marginal cost. The change in cost which comes from producing an additional unit of output.
Limitations of profit maximization as an objective of financial management. First is haziness of the concept profit. The term profit is vague. It is because different mindsets will have a different perceptions of profit. Profits can be the net profit, gross profit, before tax profit, profit per share, the rate of profit, and etc. There is no clearly defined profit maximization rule about the profits. Next, it ignores time value of money. The profit maximization formula suggests higher the profit, the better is the proposal. In essence, it is considering the naked profits without considering their timing. Another important dictum of finance says, a dollar today is not equal to a dollar a year later. So the time value of money is completely ignored. Alternatively, we can say that it ignores the timing pattern of cash flow. Next, ignores the risk. A decision solely based on the profit maximization model would decide in favor of profits. In the pursuit of profits, the risk involved is ignored, which may prove unaffordable at times simply because Higher risks directly question the survival of a business. Between projects A and B, project A may be more profitable. However, if it is substantially more riskier, project B may be preferable. Next, it ignores quality. The most problematic aspect of profit maximization as an objective is that it ignores the intangible benefits such as quality, image, technological advancements, and etc. The contribution of intangible assets in generating value for a business is not worth ignoring. They indirectly create assets for the organization. So now let us define or let us study about cost minimization. Cost minimization aims to achieve the most cost-effective way of delivering goods and services to the required level of quality. Cost minimization is a financial strategy that aims to achieve the most cost-effective way of delivering goods and services to the required level of quality. It is important to remember that cost minimization is not about reducing quality or shortchanging customers. It always remains important to meet customers' needs. So, here are the benefits of effective cost minimization. First, lower unit cost or competitiveness. Next, higher gross profit margin. Third, higher operating profits. Fourth, improved cash flow. And fifth, higher ROCE or return on capital employed. So let us now study about the two approaches to cost minimization. First, it is strategic. It is based on the business model. Its location production overseas. It has core activities versus outsourced. Next is tactical. It is focused on the detailed function. It is the choice of suppliers and its approach to stockholding. So now let us move on to the potential problems with cost minimization. Business left with insufficient capacity to handle unexpected or short-term increases in demand. Cost reductions by one department may surprise and or annoy other functions if they are not properly communicated and coordinated. Cost and revenue functions in profit maximization and minimization of losses. So, step 1. Analyze and pick a direction. Analyze the direction of the market. Look at the charts and determine if you expect the market to go up or down. Step 2. Look for confirmations or rejections. Check for confirmations or rejection of your analysis. Think about both sides and come up with reasons for why you made the decision you did, in addition to what could go wrong. This will help you more accurately calculate both the reward and risk. It will also help you prevent yourself from becoming blinded and being biased towards one side. Ultimately, this will be beneficial for two reasons. First, it confirms you actually want to make the decision you are thinking about. Next is it keeps your mental state stronger as you know that what to expect and even your analysis turns out to be wrong, you were prepared for it. Step 3. Set your stop loss. Determine a stop loss that is low enough to give rejection to your analysis. This means to set a lower boundary where if the market reaches below, you won't enter as it confirms your analysis was incorrect. Step 4. Set your profit target. If your analysis is confirmed, set analysis for where you think the market is heading. Will it go down and then up? Will it only go up? This question is key to ensuring that you get the most reward for your risk. Look at example 1 to see the possible consequences of not considering this. Step 5. Determine an entry point. The reward or risk ratio should be greater than 1 in order to make a reasonable profit. People often think that the entry point is just whatever price you end up starting a trade at. However, you should choose an entry point before making a purchase, not the other way around. And step 6, estimate your risk-reward ratio. Risk equals entry point minus stop loss. Reward equals profit target minus entry point. Risk minus reward ratio equals reward or risk. If the risk ratio, reward ratio is less than 1:1, you should adjust your entry point to make sure that you're entering at a lower risk. This readjustment is very straightforward for if you use the correct calculations for the risk and reward. So that's all for this topic.